Welcome to Behind the Money, the show where we talk about some of the most interesting public companies and people. I'm your host, Morris Willie. Today, we're talking about CPI data, core inflation, and why getting back down to that 2% target might be more difficult than we thought. While watching Behind the Money, remember, this isn't financial advice and shouldn't be taken as financial advice. This is only for entertainment purposes only. Now, back to the video. The Bureau of Labor Statistics dropped a softer than expected inflation report for the month of October. Headline inflation for the month came in at 0%, unchanged, while core inflation, which excludes food and energy, came in at 0.02%. On a year-over-year basis, headline inflation is now 3.2% and core inflation is 4%. With this news came an over 2% rally in the markets, but looking more closely, this data also showed that getting down to that 2% target is going to take some patience. CPI data came in below expectations across the board as the increase in health insurance was offset by a sharp decline in used auto prices, gasoline, and shelter, said Seeking Alpha's investing group leader, Moit Capital Management's Michael Kramer. What a title. With CPI data coming in flat month over month versus expected 0.01% rise, it could suggest that the economy is now decelerating faster than previously thought. On a month-over-month basis, October's headline inflation was the lowest of the past 12-month window and the second lowest since the start of the pandemic. Core inflation of 0.2% remains a little more stubborn, with October's reading being the third lowest in the last 12 months. The experts knew what they were doing when they created a measurement that excluded food and energy. While consumers may need food and energy, removing them from the inflation measurement allows investors and economists to analyze pricing without these volatile factors. Housing and rental inflation, which was under 3 and 4% respectively prior to the pandemic, also is trending above those levels for the foreseeable future. If you take the last 6 monthly inflation reports and annualize them, housing is trending at 4% and rent is trending at 6%. The combination of services, housing, and rental still trending above means that the segments of pricing that are currently pushing pricing down will need to continue to weigh down at their current weights, which means deflation in sections of the economy. Just a side note, if you're still watching the video, do us a favor and hit that subscribe button. Behind the Money is getting back on track and we are headed towards 1,000 subscribers. Be a part of the journey by subscribing to Behind the Money. Now back to the video. The specifics of today's inflation report continue to demonstrate that the distribution of price increases across our economy remains highly scattered. To achieve 2% inflation with elevated housing and services pricing, durable and non-durable goods pricing must remain deflationary, leading to profit pressures for those various industries. Over the next 6 to 12 months, we will see just how difficult this effort truly is. Let me know all your thoughts on this down below. The market definitely reacted great to the stagnant CPI report, and I want to know your thoughts. Leave a comment below, tell me what you think about the report, and I also put a poll up on our community page asking, are you satisfied with the report for October? Vote yes or no, and thank you for watching Behind the Money.